Imagine a single central bank, not of a small, struggling nation, but of the world's third largest economy, holding over 50% of its government's debt. This isn't a hypothetical scenario. This is the astonishing reality of Japan's central bank, the Bank of Japan. For years, it's been dismissed as a mere quirk, an anomaly that couldn't possibly destabilize the global financial order. But what if that dismissal has been a catastrophic miscalculation? What if the very policies that have propped up Japan's economy are now forming a seismic crack beneath the foundations of the entire global financial system, poised to trigger a crisis far more insidious and widespread than anything we witnessed during the Greek debt debacle? This video isn't just going to tell you about Japan's economic woes. It's going to pull back the curtain on the quiet, creeping danger its unique situation poses to every major economy, every investor, and every pension fund around the world. We'll uncover why Japan's seemingly contained problems could unleash a torrent of instability, forcing you to reconsider what a true global economic threat actually looks like, and why ignoring this particular truth could come at an unimaginable cost. Japan's economic predicament, often compared to a slow-motion car crash, is a complex interplay of unprecedented demographic shifts, unorthodox monetary policy, and staggering public debt. The country has battled deflation and sluggish growth for over 3 decades, a period known as the lost decades since the early 90s. Its national debt, a staggering 260% of its gross domestic product, dwarfs that of any other major economy, including Greece's peak. Yet, the prevailing narrative has been that Japan's debt is different because it's largely held domestically. This domestic ownership, coupled with a loyal, savings-oriented population, has allowed the government to borrow immense sums at near zero or even negative interest rates. This seemingly stable facade, however, conceals deep vulnerabilities, particularly concerning the increasingly unsustainable role of the Bank of Japan. The central bank has engaged in an unprecedented quantitative easing program, buying vast quantities of Japanese government bonds, or JGBs, to suppress long-term interest rates. As of recent data, the Bank of Japan now holds well over 50% of all outstanding JGBs. This dominance has severely distorted the bond market, effectively destroying price discovery and liquidity. When a central bank becomes the primary buyer, it's no longer a free market, and the true cost of government borrowing is obscured. This monetary experiment has pushed the Bank of Japan's balance sheet to over 130% of Japan's gross domestic product, a level unheard of among major central banks. This is not just an academic statistic, it represents a monumental gamble with the nation's financial future. The Bank of Japan's deeply entrenched policy of yield curve control, or YCC, is another critical and increasingly fragile pillar of Japan's economic stability. Introduced in 2016, YCC aimed to anchor the 10-year JGB yield around 0%. The Bank of Japan committed to buying unlimited amounts of bonds to defend this target, effectively putting a cap on interest rates regardless of market forces or inflationary pressures. For years, YCC worked, keeping borrowing costs low. However, as global inflation surged in the early 2020s, Japan found itself in a unique predicament. While other central banks were aggressively raising interest rates, the Bank of Japan was forced to defend its 0% yield target, even as inflation slowly crept up domestically. The widening interest rate differential between Japan and the rest of the world put immense downward pressure on the Japanese yen. A weaker yen, while initially beneficial for exporters, quickly became a double-edged sword, making imports, especially energy and food, significantly more expensive. This imported inflation began to squeeze household budgets and corporate profits. The Bank of Japan's rigid adherence to YCC also created massive distortions in the JGB market. Investors pulled back, leading to periods where no one but the central bank was willing to trade JGBs at the targeted yields, effectively freezing parts of the bond market. Facing increasing pressure from a depreciating yen, persistent inflation, and a distorted bond market, the Bank of Japan finally began to make incremental adjustments to YCC in late 2022 and through 2023. These cautious shifts were attempts to regain market functionality without triggering a full-blown crisis. These adjustments, however, led to increased volatility in the JGB market and renewed speculation about the Bank of Japan's exit strategy. The mere anticipation of a significant shift in Japanese interest rates sends shivers down the spines of global investors, as it could unravel one of the largest and longest-running carry trades in financial history. Perhaps the most insidious and long-term threat to Japan's economic stability, and by extension the global economy, stems from its unprecedented demographic crisis. This is not a problem that can be fixed with monetary policy or fiscal stimulus. It's a deeply structural issue. Japan has the oldest population in the world, with over 29% of its citizens aged 65 or older. This is exacerbated by a critically low birth rate. The implications are stark: a declining workforce, fewer taxpayers to support a growing elderly population, and an unsustainable burden on social security and healthcare systems. A shrinking labor force translates to lower potential growth. An aging population means higher healthcare costs and pension payouts, straining government finances. The dependency ratio is soaring, putting immense pressure on the dwindling working population. This demographic time bomb also impacts domestic consumption and investment. An aging population tends to consume less, favoring savings, which further exacerbates deflationary pressures. Businesses struggle to find workers, hindering expansion. While immigration could help, Japan has strict policies. The combined effect of declining births, an aging population, and limited immigration creates a vicious cycle that monetary policy simply cannot break. The Bank of Japan can flood the market with liquidity, but it cannot create new workers or reverse the demographic tide. This demographic reality makes Japan's economic situation fundamentally different and potentially far more perilous than any sovereign debt crisis driven solely by fiscal mismanagement. Now let's talk about the global implications, because this isn't just a problem for Japan. The sheer scale of Japan's economy, its deep integration into global financial markets, and the widespread use of the Japanese yen in global finance mean that any significant instability in Japan could send shockwaves across the world. The most immediate risk is the unwinding of the yen carry trade. Global investors have borrowed yen at Japan's near-zero interest rates and invested that money in higher-yielding assets elsewhere. Estimates suggest the total value of the yen carry trade could be in the trillions of dollars. If the Bank of Japan were to significantly raise interest rates, or if there were a sudden surge in JGB yields, these carry trades would rapidly unravel. Investors would rush to sell their higher-yielding assets, causing bond prices to fall globally, and then buy back yen to repay their loans. This sudden flood of capital out of other markets could trigger widespread financial instability, especially in emerging markets. A sharp rise in global bond yields would also increase borrowing costs worldwide, potentially tipping fragile economies into recession. Furthermore, Japan is a major global creditor. Japanese financial institutions hold massive amounts of foreign assets, including U.S. treasuries and European bonds. If domestic financial stress were to force these institutions to repatriate capital by selling off their foreign holdings, it could trigger a global sell-off in bond markets, pushing up long-term interest rates and tightening financial conditions globally. This would be a liquidity shock of monumental proportions, far greater than anything seen during the Greek crisis. This brings us to a controversial opinion. The world has fundamentally underestimated the systemic risk posed by Japan, focusing too much on past crises like Greece, while ignoring a ticking demographic and monetary time bomb that could be far more disruptive due to its sheer scale and integration into global finance. When Greece faced its crisis, the concern was primarily about the Eurozone. Greece's economy was minuscule by global standards, and its central bank policy was dictated by the European Central Bank. Japan, however, is the world's third-largest economy, a global financial powerhouse, and its central bank wields immense control. The nature of its debt, while largely domestic, is also its Achilles heel. If domestic confidence were to waver, or if the Bank of Japan were to lose control of its yield curve, the sheer volume of JGBs held by its own citizens presents a unique and terrifying challenge. There's no external entity like the IMF waiting with a bailout package for a country of Japan's scale. The magnitude of the Bank of Japan's balance sheet, disproportionate to its GDP, means that any significant unwinding of its quantitative easing program could have ripple effects that dwarf the impact of the Greek crisis. The carry trade is a silent, pervasive global risk that would unleash trillions of dollars in currency and bond market volatility. The interconnectedness of global financial institutions, many of whom have deep ties to Japanese banks or are exposed to yen-denominated assets, means a severe Japanese financial shock could lead to widespread insolvencies and a global credit crunch. While Greece was a fire in a small house, Japan is a potential fault line running beneath a continent-sized economy, with the capacity to trigger global financial earthquakes. The world has looked away, lulled by years of apparent stability, but the underlying pressures are building, driven by irreversible demographic realities and monetary policies pushed to their absolute limit. The unique combination of Japan's demographic decline and the Bank of Japan's extraordinary monetary policies creates a feedback loop that makes any exit strategy from quantitative easing incredibly difficult and risky. As the population ages and shrinks, the pool of domestic savers, traditionally the buyers of JGBs, also diminishes. This means the Bank of Japan's role as the buyer of last resort becomes even more entrenched. Any attempt by the Bank of Japan to significantly reduce its bond purchases or raise interest rates, while necessary, risks crashing the JGB market, sending yields soaring, and making the government's colossal debt burden unsustainable. Such a scenario could trigger a severe financial crisis. Maintaining ultra-loose policy risks continued yen depreciation and imported inflation. Tightening policy risks a domestic bond market collapse. Furthermore, the Bank of Japan's massive balance sheet means any significant rise in interest rates would lead to substantial unrealized losses on its holdings. While a central bank can technically absorb losses, it complicates future monetary policy and raises questions about its independence and credibility. The longer the Bank of Japan maintains its unconventional policies, the larger its balance sheet grows, making any eventual return to normalcy exponentially more challenging and fraught with systemic risk. Ultimately, the story of Japan's prolonged economic struggle and its radical attempts to overcome it offers a chilling lesson for the entire global economy. It's a testament to the powerful long-term impact of demographic forces and the immense challenges of escaping a deflationary trap. The comparison to Greece, while useful for highlighting debt levels, ultimately falls short in capturing the full scope of Japan's potential systemic threat. Greece was a local problem. Japan, due to its economic scale, its deeply interconnected financial institutions, and the sheer volume of its debt and monetary policy experiments, represents a global systemic risk unlike any other. We are living in an era where central banks, pushed to their limits by unconventional policies, are navigating uncharted waters. Japan is at the very vanguard of this experiment, and its eventual outcome will undoubtedly send reverberations across every major financial market and economy. The truth you ignore about Japan's quiet economic crisis is that it's not just their problem. It's a potential catalyst for the next major global economic shock, one that could redefine market dynamics, expose vulnerabilities, and force a reckoning with the limits of monetary policy itself. It demands our attention, not just as economists or investors, but as global citizens, because the consequences of underestimating Japan's unique predicament could be profound. The debate is no longer if Japan's economic model faces an ultimate reckoning, but when and what form that reckoning will take. The ramifications of this truth are still unfolding, and understanding them is crucial for anyone navigating the volatile landscape of the global economy. If this deep dive into Japan's intricate economic situation has given you a new perspective, or if it sparked some crucial questions, make sure to hit that subscribe button. We're dedicated to uncovering the complex realities that shape our financial world, and you won't want to miss our next critical analysis.